What up, what up, what up? This is Khalid Nathan Aleem, the real estate boy, and welcome to Real Estate with Soul. This is a program that's dedicated to just talking to dope real estate people that's really doing it big in our industry at this time, man. So today I got a special guest, Lester Brown. Let me bring on Les right here. Good morning, Les. How are you?
Good morning. Good morning. How you doing?
I'm good, man. Why don't you introduce yourself?
Yeah. My name is Lester Brown. I'm the co-founder of Affluent Mortgage, local mortgage brokerage here in the Delaware area. Been in the game for 10 plus years, doing various different things in the mortgage industry. Some behind the scenes, some in front. So just here to bring knowledge and education to everyone who's looking to purchase or refinance their homes.
Awesome. Now, Les is no stranger to the program. He's been on before. But for the people who this is their first time watching this, man, why don't you give us a quick background?
Yep. Started out, I want to say around 2008 as a housing counselor. So I got in right when, foreclosures were at its all time high. A lot of people were losing their homes. So I kind of got to see the industry on the back end or the waning moments of the industry. From there, went to Bank of America to do some short sales, deed and lieu, some processing, some underwriting, just kind of back office stuff to kind of get my feet wet and learn more about the industry. From there, I went to another different mortgage company doing some more underwriting, and I got tapped on the shoulder by the sales manager. And was like, hey man, why don't you, think about being a loan officer? And I was like, nah, man, I'm cool on being I'm cool on being a loan officer, man. I really like my little back office job. Um,
Right.
he really kind of stuck with it and kind of kept prodding me to kind of move forward. So eventually I was like, all right, man, let's see what this is all about. And that was 7 years ago now. Still here, still trying to help families kind of navigate these waters that are for people that look like us very much not we're not given the same opportunity statistically. So to have people in the industry that look like us, care about us, and know about our plight is kind of a big deal to me. So, just want to help people, one house at a time for sure.
Yeah, you touched on something big, man, and that's the caring part. If it's one thing that I understand now that I didn't understand before is, yeah, if I was part of the general public and I'm looking at these statistics and I'm like, wow, it seems like black and brown folks are behind the eight ball when it
Hmm.
comes to lending, when it comes to buying homes and so on and so forth. I do think that's half the story. The other half of the story that people aren't getting unless you're in the industry is the professional that's taking care of you actually caring about your situation.
Yep.
Because most of the time, if I can't get it done here, I can get it done over here. I can get it done over here. I can get it done over here.
Hmm.
But if I have if I have this, and it shouldn't be like this, but a lot of times it is. If I have this $800,000 property that needs my attention versus this $200,000 property that needs my attention, I have one attention, so it has to go
Hmm.
somewhere.
Hmm.
And a lot of times it's going to go to the $800,000, where a lot of us is at the 200 or 300. So
Yep.
um, I'm glad you talked about that, man. But this program, a lot of times on this program, I want to talk about different lending programs
Hmm.
that loan officers have that might be special to their particular case, or it may be a proprietary situation, because a lot of brokers, or not brokers, a lot of lending officers that I bring onto this program,
Hmm.
they're a part of one bank, or
Hmm.
they're a part of one lending institution.
Hmm.
But your situation is a little different, man. Can you speak on how your situation is a little different?
Yep. So coming from where I was, before I started Affluent, we were like that. Well, so one mortgage company, you're under that umbrella, and whatever products they offer, you're pretty much tied to that. You're tied to their underwriting guidelines. You're tied to their turn times. You're tied to whatever they say in house. And for years, I always worked like that, and I thought that that was the way to go. Well, when me and my business partner started this, we found out that there's a whole new way or not a new way, but a whole different way that we can do business in the mortgage industry. So as a broker, basically the difference is instead of us doing everything in house, we have multiple lenders that we can go to. We just literally signed up a new lender yesterday. So how it works is, let's say you come to me and you have a 605 credit score.
Hmm.
Now, FHA, let's say FHA goes down to 500,
Hmm.
but your mortgage company doesn't start until 640. So if I come to you at 605, you can't do it at that mortgage company. So it's like, man, hey, sorry, it was nice having the time to talk to you, but it's nothing that I can do for you. But if you come to me now, able to shop different lenders. So different lenders have different thresholds or different things that they feel makes them more palatable. So a 605 to one company may be like, yeah, we specialize in those kind of deals, or we specialize in um, if you have like some lenders want a paper, some lenders want the kind of deals that are kind of little hairy. They specialize in those kind of deals. Some lenders want deals that are just non-traditional deals. So each lender has their own appetite for what they're looking for. So as a broker, I'm able to go out, find different lenders, and see exactly what their appetite is, and put you in with that lender so that you can get approved.
Awesome. Great explanation, man. Um, One of the things that we wanted to talk about today is you got a lot of people that's looking to invest.
Mhm.
You got a lot of people, and um, I mean, that's something that's hot on social media right now:
Yep.
investing, investing, investing.
Yep.
Um, Wanted to talk to you about some of the programs that you had specifically for investors.
hmm Yeah, so so when people hear investor, I think they think, a lot of cash, been doing this for, a huge real estate portfolio. They've been doing this for a long time. But to me, an investor is really someone who wants to use real estate as a way to create income for themselves. So,
Mm,
or not live in that property that they're investing in. So that's what I think of when I think of investor. So with that, there's so many different programs. Like I have a client who is a travel nurse. So
mhm,
she's not really laying roots down because she's everywhere. So she has money, but she doesn't really have a primary residence. So it's like, all right, the issue with her is how do we kind of, make the travel nurse income work? How do we get it so, she's not living in the property? And then get her into something that can kind of work. So it's more so about the situation of the person first, and then the loan product second. So the product, and let me just back up real quick. Investing, like you said, is real hot for a couple reasons. One, investors really aren't as worried about interest rates as the person who's going to live in the property. Investors may pay 10, 11, 12, whatever percent on a hard money loan for, 6 to 12 months. So they're not really focused on that singular number. They're more so looking at the product in totality. So they're trying to say, all right, if I have a 10% interest rate, they're not going to get a 10%. But let's just say I have a 10% interest rate and my mortgage is going to be this, but my rent is going to be this. I'm doing the deal because it makes sense financially. Whereas someone who's living in the property, they see a 8% interest rate, they're like, oh man, rates are too high. So it's a different mindset when an investor comes and looks for a property versus
right.
when someone who's a first time home buyer. So another reason why investing is so big right now, the properties that are on the market, a lot of them need work.
Mm,
And a lot of people who are first time home buyers, they want move in ready properties. So
right.
it's like, all right, now it's pretty much your investor is really your main client because you see something for 150, but he knows the ARV for that might be 350, if I do a little work to it. Whereas somebody who's in the home, they're like, man, I'm trying to just, I work every day. I'm not trying to, be on the weekends doing projects. So
Right.
it's a different mindset. So when I have an investor come to me, the first thing I want to know is, what are you trying to do? Are
Right.
you trying to flip it? Are you trying to hold it? Like, are you trying to, get some money out of it? Like, what are you trying to do? And once I kind of know that, then I know exactly how to do it. But the product that really is taking off right now, and a lot of different lenders have this product, um, is DSCR loan, so debt service coverage ratio. So basically, what that loan is doing is, instead of looking at the borrower or the investor per se, it's more so looking at the property's ability to cash flow. So let's say you're an investor, you have 10 properties under your name. Unless you're a multi, you have a high net worth, your DTI, you're not going to qualify for many more properties over that. So with this, it allows you to close in an LLC. They're not looking at your debt to income ratio because it doesn't really matter. They're looking at the amount that the property can generate in rent versus the amount that the mortgage is going to be. So as long as you're higher on the amount that you can generate in income than you are in your mortgage, you're going to get approved. So they're looking at very minimal documents. So credit score, obviously, you want to have, like, we have lenders that say 620 for this
Hmm.
type of loan with no experience, but your rate is gonna be pretty high.
Hmm.
Now, if you can make the deal work with the high rate, then let's rock out. But I say you want to get your scores up. Also, the lower the score is, more than likely, the higher the reserves they're going to ask for. So reserves are 1 month's mortgage payment is a reserve. So they may say we need 3 months reserves. So not only do you have to come up with closing costs, down payment, now you got to add on those 3 months reserves or 6 months reserves or whatever they're asking for based on your credit situation. So you want to make sure that your credit is up there with someone who's trying to invest in real estate. This is not for people who, trying to first time home buyers. It's not really for them. So make sure you have your credit on point. Make sure you have some money that you can show on point. So, trying to get gifts and all this stuff, down payment assistance. This isn't the program. This is more so for people who are either established financially, or they're trying to get to a place where they're building their real estate portfolio. But once you kind of have those things covered, is pretty much a sweet deal. You're closing the name of your LLC, so they're going to review your LLC documents. So they're gonna look at your credit personally, but then they're going to close in the LLC. So when someone runs your credit, that house doesn't come up there. So now you can have multiple properties financed under your LLC, and it doesn't affect you personally. Versus if you're doing Fannie Mae, Freddie Mac, FHA, more than likely you're going to close that one in your name. When somebody pulls it up on your credit, that's going to be on your debt to income. This is totally separate. It's pretty much its own type of situation on the side.
Okay. So, just to take it through the profile that this would be good for,
Hmm.
like you say, and you've already said this, it's not going to be good for your first time home buyer. Your first time home buyer, they're going to want to live in the property. It's better for them to get a traditional loan. Um, Try to get some type of down payment assistance. If you
Yep.
are looking to get your first home, definitely contact us because we have programs for that.
Yep.
Then your next couple of homes, you should be able to qualify as an investment property.
Yep.
If it can qualify for an investment property, then that's probably going to be a better situation than getting a DSR loan. Because the thing that people have to understand about loans in general, and you can back me up on this, is
Hmm.
that the more things you ask for the loan to do, the more expensive the loan gets.
Hmm.
So the more exceptions you want the loan to make, the higher the interest rate or the higher the points, or the loan is just more expensive just in general, no matter
Yep.
which way it comes in
Yep.
to you. So if this is your second property, or this is your third property, you can still get it in your name as an investment property, which is going to make it less expensive for you. But then as you get higher, five, six, seven, eight, and you go up, like you said, your DTI is going to start to take a hit, and
Hmm.
you may not be able to get homes in your name anymore. So now you got to turn to the commercial side of things.
Hmm.
When you turn to the commercial side of things, you're saying that this might be suitable for somebody, and you're really looking at the numbers, because what I find is that a lot of first time home buyers, it's hard for them to transition. from
Yeah.
being a home buyer to an investor.
Hmm.
And they want to go, for example, they want to go see this home, that home. Well, when you're an investor, going to see the home is really one of the last things that you do
Hmm.
before you run your numbers.
Yep.
And it's really all about the numbers. And I
Yep.
think that's where a lot of people get twisted at, is that
Yep.
they, oh, I want to go and see how the house feels. You're not living there.
Right.
So it doesn't matter. It
Right.
doesn't matter how the
Right.
house feels. You're not living there, somebody else. What
Hmm.
matters is the numbers.
Yep.
Um, do you see that a lot also?
For sure, for sure, especially for a lot of, like you said, first-time investors. They're more so worried about, you know, like you said, what is it? What does it look like? What does it feel like? All this kind of stuff. What you really should be focused on is the location.
Mm,
Like, is it a location that's going to increase in value? Is it on? Is it up and coming? That's where you want to get in at. Do the numbers work? Like, are you going to cash flow this property? If you're going to cash flow a property monthly and you're going to make money in the long run because this area is somewhere that you can see um, higher returns coming later, that's where you want to go. It doesn't matter how it feels. Because as an investor, you can change the feel of the property once you get in there, because that's part of what you're trying to do. Speaking of that, there also we have loans for people who don't have money for a renovation. So let's just say you have money for down payment and closing costs, but you see this property that needs some work, and you're like, "Yo, I'm trying to, I mean, I want to get this joint." So we can do a fix and flip loan, and they'll give you the money for the purchase, and they'll give you money for the rehab.
mm,
Now now again, what they're looking at is they're looking at the after repair value. So
right.
let's say you buy it for 100, but they know it can sell for 250. They're like, okay, what work are you going to do? Okay, bam, they'll give you a certain amount of that after repair value because they're looking in the future,
Right.
as you should be as an investor. So the fix and flips are pretty popular. The DSCR loans are more for people who are buying something that doesn't need as much work. You like, I might have to go in and slap some paint on it. I don't need a loan for that. The fix and flip is more so if you're trying to get something that needs a gut. Boom, I need an extra 50, 60, 70,000 to kind of get this property to where it is. The fix and flip is another loan that investors can use to kind of really propel them to increasing that real estate portfolio.
Gotcha. Okay, so you spoke on. I'm gonna slow that down a little bit. You spoke on two type of investors. One investor, and this is probably more for the first time investor,
Hmm.
because a lot of times you don't want to be doing a whole gut on your
Right.
first rehab. Now, some people
Hmm.
do. Okay, so
Yep.
I'm not trying to gatekeep anybody, but for the most part, for the
Right.
most part, I recommend somebody, if they're going to get into flip or buy and hold, to do something that just needs cosmetic work on it first. And
Hmm.
you're saying, if your debt to income is a little bit up there and you can't put any more homes in your name, and you want another option, then this DSCR is another option where, and again, I guess this is the biggest thing, is that the onus is not on you. The
Right.
onus is on the property. Now,
Correct.
my question to that is, when they're looking at the rents, is it rents that it has to have currently, or is it projected rents?
Yep. It comes from the so if it's obviously if it's receiving rents, cool, we'll rock with that. But if it's vacant, the appraiser is going to set the rent price. So he's going to look at rents in the area, and then he's going to say, all right, this one can rent for 1,500, in this area based on rents. So that number is going to come from the appraiser to dictate what those rents look like. Like I say, obviously, if it's already rented and you at lease agreements and all that kind of stuff, then
Mhm.
boom, they'll rock with that. But they're going to go off of what the appraiser says for that value.
Now, how low do they go? I mean, as far as value rate. And the only reason I'm asking that, because I just went and saw a house in North Philly yesterday,
Hmm.
and I'm looking at it. And when I looked at that, I was doing the comps
Hmm.
in the area, and I mean, I seen some $25,000, $45,000. So, how low? How low does it go?
So you mean for assessing the value or assessing the rents?
Purchase price.
Yeah, so they're gonna look at the same thing that you're looking at. Like
Mm,
you guys are basically looking at the same thing. The only thing that their appraiser is going to do a little bit more in depth than you would do on your CMA is probably like deductions and all that kind of stuff for size and patios, and this one's new, this one's not new. Like they're going to actually put a dollar amount to all that stuff, where you guys are going to be more so like, this is probably an extra 5 grand or whatever. They're going to actually put a, I don't want to say scientific number, but it's an actual calculation to it.
Right.
But other than that, you guys are pretty much using the same numbers to come to the numbers that you guys arrive at.
Okay. Well, no, I guess what I mean is that this DSCR loan
Hmm.
is not a fix and flip loan to
Right.
where, like you said, if it's a gut, if I got something down to the studs, I'm probably
Hmm.
gonna not gonna use a DSCR loan. But if I go into a house that just needs cosmetic work,
Hmm.
um, how would that work as far as, just say the house costs $50,000,
Hmm.
and let's just say the work is $10,000,
Hmm.
then would I be getting a DSCR loan, and then I'm on the hook for the $10,000, so I have to have a budget of the $10,000, or will
Correct. Yep.
will that DSC loan cover that also?
Nope. The
Okay,
DSCR is more so. It's the DSCR purpose is you close and you about to have somebody in there,
okay,
30, 60 days or whatever. The fix and flip is more so you're gonna be working on this for the next 3 to 6 to 12 months,
okay,
kind of getting it where it needs to be. So DSCR is more so like, I'll say DSCR is like FHA. You need to move in
okay,
right away, or move, or you not need to move in, but you need to have a tenant in there right away. Like it's not so much for repairs and all that kind of stuff.
okay,
Now, what will happen though is the appraiser will call out stuff on the appraisal that needs to be corrected. So I literally just closed one out last week, and there was repairs that needed to be made. So they're still looking at health and safety stuff. So all that stuff that the normal appraiser will look at, that appraiser is still going to look at that stuff. So more than likely you're going to probably have to go in, paint, do some other stuff like that. But
hmm,
again, you're an investor, so now it's on you, and when you're getting that loan, you're saying, I have the resources to get this where it needs to be, so it can rent for the amount that I want to get for it.
okay. But this is not one where you want to get this loan and think about doing a refinance in like 6 months or 7 months. This is not one of those loans, correct?
So you would do a DSCR off of a fix and flip. So
Okay,
if you fix and flip and you're
okay,
like, oh damn, I thought I was gonna sell this joint, but this joint actually, the rents is crazy. I want to
gotcha.
keep it. So instead of selling it, you would do the DSCR off of that, rent it
Okay.
out, take the bread that you pull from the DSCR, and move on to another one.
Okay, so
Yeah,
it's on the other side of it.
right,
Because my question was on the front side of it. Like, so,
right.
like you said, you have a house that you want to fix up. Now, how does this fix and flip loan compare to a hard money loan?
Yeah, so it's basically the same thing, but
Okay,
from the mortgage side. So hard money is, so people here use a lot of terms interchangeably.
okay,
Hard money, private money, fix and flip. They're pretty much the same idea. Hard money is one
okay,
person. Like, let's say you want to start making money on your investment. You start giving your personal money to investors, and then they're giving you money on your return. That's hard money. That's one person's money. That's where he's trying to make money off of it. Private
mm,
money is when a group of investors put their money together to give to real estate investors to use, and then they're going to make a profit off of it. And then the fix and flip is more so from an institution's perspective. So, like if you
okay,
hear a bank or a mortgage company or something like that, when they're talking about fix and flip, it's pretty much the same thing, but it's coming from the institution side versus a group of people or an individual person.
okay. No, that definitely makes sense. Now, what if a person has a property already? And the only reason I'm asking is because I had a person ask me this today, or
Hmm.
not this day, but last week.
Hmm.
If you have the property already and
Hmm.
you just want to make the repairs to it,
Hmm.
can you get just a construction loan?
Yeah, I mean, you can do a home equity line of credit for that and use that
Okay,
to do the repairs. Like you don't
okay,
necessarily have, and I would probably advise you to do that because
okay,
the rates are going to be way more favorable than you trying to get, some type of fix and flip loan or anything like that. So yeah, I would just say you do a home equity line, however much you need, and then you're more than likely gonna, if you're gonna hold it, um, that's probably when. So that's why I need to know what the strategy is. Like, what are your end goals? Like, are you trying to rent it out And you're
Right.
like, okay, this rent is going to cover this mortgage payment that I'm going to get.
Hmm.
Um, but there's different ways to kind of pull the money out. You can do a cash out refinance. You can do a bunch of different things to kind of get the money out of the property that you already own.
And that's why it's super important to be clear. It's
Hmm.
super important to be clear on what you're looking to do.
Yep.
Because once you're clear on what you're looking to do, it's just like going somewhere, having a destination. You have a destination, then you have a clear path on how
Yep.
to get there. But if you don't have a destination and you're just wandering around and you just want to make money, as some people say, well, I just want to make money, then you're
Right.
all over the place.
Right. And no money will be made. No money will $0 will be made under those circumstances.
Right. That's why you got to get with a professional.
Yep.
And if you got to think through it or talk through it, then do that.
Yep.
But you'll get with somebody like Lester and sit down, tell him what your goals are, and then he'll put the best things in place to kind of get you there.
Hmm.
Um, what what have you been seeing in this market, man? I mean, the market's kind of been up and down.
Yeah.
These past couple of weeks, we hit like a 22 or 22-year high, 21 or 22-year high. Now we've kind of pulled back from that, man.
Yep.
But let's talk a little bit about the market just in general, man. What have you been seeing out there?
Yeah. I'm starting to see an increase in applications.
Mm,
So people, I don't know if they're prepping for spring market and they're trying to, get their ducks in a row now. But we're definitely seeing an increase in applications. We're seeing an increase in investors. So people who used to pay cash for properties are now looking to do mortgages. So I don't know if their money is drying up or if they see like, yo, all right, there's other ways that I can use my money that I have available to me. Like I have an investor, she's out shopping right now, and she used to buy all her houses were flips. Boom, get it, renovate it, get rid of it, take the bread. And she's doing the loan now. She's doing the DSCR. So she's trying to get into the rental market. So we're seeing a lot of that going on, almost to the point where lenders who never offered these types of products before,
mm,
everyone, damn near every lender that I work with works with some type of these non-traditional loans. Because if
mm,
you don't, you're going to get left out because it's such a growing market and the loans perform so well. They're right under conventional in the way that they perform. So
wow,
a lot of investment properties are being purchased right now. And I think is due to inventory, but it's also the type of where people are. You have gig workers, you have people who are,
mm,
self-employed. So they're like, man, do I really want to, settle down and buy my primary house? Let me just get this investment joint and it's making me some money. I just got to put a couple dollars up and then I can get, my investment and then I can start building my portfolio while I still do this other stuff.
right.
So I think COVID has changed the way people look at housing, especially from a am I going to live in it perspective. A lot of people now are mobile, so you can work from anywhere. You can be in the Bahamas doing
Mm,
you don't know where I'm at right now. So it's
right.
like, why do I really need a primary house? Is a lot of people's thinking. So those investment products are really taking off, but people are still clamoring for those, first time home buyer. Like I'm doing, Philly First and Delaware County grants, and people are still grabbing those as well. But we're seeing an increase in investors really coming to the market at this time to kind of get what's out there right now.
Now, in reference to this DRC loan, how many units can I purchase? Up to four?
So up to four, anything over four is going to go into commercial DSCR.
Okay.
So it's pretty much the same thing, but on a broader scale. So
Okay.
you can do a DSCR for apartment complex,
Oh
like
wow.
yeah, 10 units, like same thing. Because the numbers are the numbers. The bank
Right.
is like So if that bank specializes in commercial, and you bring them a 10 unit deal, and the mortgage is 7 grand a month, but your rents is 9 grand a month. Yo, we got a deal. You got the down payment and closing costs.
Right.
Let's rock this joint out. So, yep, you can do DSCR on the commercial side as well.
I did not know that. Okay. Yeah, that definitely works. I guess in Philadelphia, and specifically, not to
Mhm.
change gears here, but
Yeah.
as far as first time home buyers, like what have you been seeing out there? I guess with the rates coming down a little bit.
Yeah, I mean, it's still the same thing with me, at
Mm,
least with my buyers.
mm,
Everybody wants rehab, new, shiny.
mm,
And I don't think there's a lack of those properties out there because of the investors that we're talking about. So, but I don't think those investors can turn over those houses fast enough to meet the demand of
mm,
all the people who want those types of houses. So all of my buyers that come in, none of them that are looking to be first time home buyers, none of them are like, yo, let me get a joint that needs some work. He's they're not thinking like that. They
right,
thinking like, yo, I'm trying to, I want to do Christmas is coming. I want to have family over. I want to do parties. I want to entertain. I want to walk in and have it already be done. But if you're an investor, you bought the house, you looking at probably 6 months at least before you can get that on the market. So it's like,
right,
and you're more than likely doing maybe one, two, three of those at a time. It's just not enough demand to meet this, or not enough supply to meet the demand of the people who are trying to get those types of homes.
yeah. I mean, they're definitely out there, and depending on the price point,
Hmm.
um, because
That's
I
another
feel
problem. I hear, not to cut you off. I'm on social media a lot, and what you see a lot of times people are saying, "I'm not paying 300,000 to be attached to somebody else." It's
right,
like, well, these are somebody is though. So
right,
cool, you can sit on the sideline and rent something
mm,
and give your money to your landlord, who's just going to turn do the same thing we're talking about right here,
right,
or you can get your piece of the pie and not so much worry about where the property is, because that's where Philadelphia real estate is. You're going to be living next to somebody more than likely,
right,
and it's going to cost you a couple of dollars. The $100,000, $150,000, you're
Ooh,
gonna be in some suspect suspect areas, man.
right,
So
right,
you have to be you got to take the good with the bad. Like I have clients that are getting, I have one who's about to close. He was at like 130, but he's doing repairs on a house as we speak that he didn't even buy yet. So these are the type of things that you're going to see when you're at that price point. He loved the neighborhood. So he's like,
hmm,
I like this neighborhood. This joint might need a little bit of work. I'm willing to do the work while I get prepared to purchase the house. So it's got to be creative, man. This is the time to be creative. The way that things have been done in real estate the last 20, 30, 40, 80, 100, those ways is out. Like
right,
even the way that the properties are being marketed, even the way that the properties are people are coming to, even the way that a person can look at properties. Like
right,
people can technically go in and look at the, I mean, Zillow and Redfin and all these other companies, they make it so easy for you to get access to these properties. Like you
right,
don't have to sign contracts. They'll do it, they'll get you right in the building. Like, yo, you want to go see this joint at 5 o'clock? We got a loan officer, we got a real estate agent, we got a title company. We can do all this for you today. Whereas 10 years ago, it took you a minute. You had to look in, go through this person, talk to a realtor. The realtor had to give you the loan officer. Everything is so much faster. So we have to kind of change with the times as the professionals in this industry.
Well, one of the things that I've been hearing is multi generational buying.
Mhm.
Have you had any buyers come to you where they're living with the mother-in-law or the father-in-law, or they have multi generations in one house?
So I haven't had that personally. I did have a young lady say she wanted to buy a house for her daughter, but that is definitely big. And I'm also seeing builders, not on our side of the country, but builders are starting to build like small miniature houses. So they'll have like a big house and then they'll have a small miniature house for the family member to come live in.
Right,
So that's another wave that we're going to. I don't know if it's going to get here in Philly because we're pretty much, where we're going to be as far as footprint is concerned for the most part. But you look at some places where they're building out in, the Lennars and
mm,
Ryan Homes, they may start to actually incorporate that kind of stuff into their footprint because you need at this point, man, with the way the housing prices are and incomes, you need multiple incomes for the most part to kind of get into these properties.
yeah, no, you're You do. I mean, that's one thing, but the other thing is having that parent there. Number one, to help with the bills, and number
Yeah.
two is if you have children, helping with the
Hmm.
childcare. I
Yep.
mean, I've always thought like that was a big help, and I mean, even me in my situation right now, I'm living. My mother-in-law lives with me,
Hmm.
and it's awesome.
Yeah.
And listen, it's as they say, the best thing since sliced bread, because you can you can leave the children with somebody
Hmm.
that you know is going to take care of them like a parent,
Yep.
and with that love, not just doing it because you're paying them to do it. Now,
Hmm.
I know that there's some people that got issues with their family, and it's just like, hey, okay, I don't want to be next to my mom or be
Right.
next to my
Right.
father. It's like, I get it, you know what I mean? But if you could kind of get over that, um, it's phenomenal. I truly love it, man. Um, but not to switch gears here, man. But I just want to talk quick about this zoning, what city council is doing as far as passing these new zoning overlays that restrict the height limits in Brewery Town and Sharswood. Man,
Hmm.
have you been seeing this or reading up on this?
No, I haven't heard anything about it, but it totally makes sense because, like I just mentioned earlier, the footprint is pretty much the footprint in a city like Philadelphia. Like there isn't much land available to do anything, so they're either going to have to go down or they're going to have to build up.
Go up, right?
So, and I've seen the building down. I've seen them do like, they'll build down and create like duplexes. So like one will be down underground sort of, and then they'll
Hmm.
build up to the regular height. But this makes sense, and it kind of, from a city council perspective, I guess they trying to keep it from. They don't want to open up that can of worms because once you start doing that, it makes it the it's gonna mess up the values because as soon as one person comes in and throws up a a 3, 4, 5 story house where it was just 2 story, now the comps are all off. Now everybody is a race to kind of compete with that. The structure is kind of is the structure even available to handle that from that perspective? So I can see where city council is going with it, but I don't know if they're going to have I don't know how long they're going to be able to stand on that hill with the housing being the way that it is. That may be the only option that we have at this point in a city like Philadelphia.
Well, I guess that's my point, and I guess that's what I guess I'm on the other side of it with a lot of other kind of real estate investors is that you're limiting those people.
Hmm.
So now I live in Brewery Town, and I mean, you know, Brewery Town, there's a bunch of rooftop decks on Brewery Town.
Yep.
But
Yep.
now, when it's my turn to do it, I can't do it now
Right.
because
Right.
now mine's is restricted. I mean, I really feel like it's like a dollar short and a day late
Yep.
because now I can't compete with none of these. So you're really handicapping me
Hmm.
as a resident because
Hmm.
now I can't put a roof deck on mine's, but
They're already there.
uh,
They're in
you
there
know,
already.
what's the one guy? Dom Construction.
Hmm.
Dom Construction got a billion of them in Brewery Town. I don't know if this is true or not. This is just a
Yeah. Yeah.
example,
Right.
but Dom Real Estate got a bunch of them. He already got his. Now it's my
Mhm.
turn, and now you're limiting mines. And
So
I
so
think that's
let
the
me
other side of the pendulum.
yeah. So let me put this out to you. Do you think it's nefarious activity that's going on, or do you think it's legit city council being concerned for the footprint of the city?
Uh, I think that man's sitting nefarious. He breaking out SAT words on Friday. Okay.
I'm just
This.
saying.
um, I think you're going too hard to one side and not thinking about the other.
Hmm.
Um, I feel like that's what's happening
Okay.
because, as you know, I'm sure you read this book, and I'm always referring to this book on this program because it's such a powerful book. The Color of Law. The
No,
Color of Law.
I
Oh
have to
man,
check it out.
you got to read that. Oh, you
Okay.
got to read that because it talks about, and I hope I'm not saying the title wrong, but it talks about how they used zoning in the past
Mm,
um,
that's
to
where I was getting with
dictate.
it. Yep.
You know what I mean? To
Mhm.
dictate where people live. And they use
Mhm.
zoning to keep us out of different
Mhm.
places. But it seems like with these particular moves, like I get what the meaning is. It's like, okay, like you had said, okay, we don't want these people to continue to come in and build up to where now these prices are going up. But okay, that's on one side. But on the other side, if this is my home and I want to keep up with these other individuals, and yeah, I may want to sell my house now. You're cutting my knees or my legs from underneath me
Yep.
because I can't build a rooftop. But
Mhm.
my man, listen, the doors open. Or like I guess that's my thing. If you had did this from the beginning,
Mhm.
okay, cool.
Mhm.
But you coming in the 12th inning, you coming in
Yeah.
on the 11th inning,
Yeah.
and then saying, "Okay, I can't build a roof deck." Well,
Right.
nah. Well, tell them to take theirs down then.
Right.
If they don't take theirs down, then I
I can
should
put
be able to
mine.
build one too.
Right. Yeah, I mean, and I just looked the book up. It's in my queue. It's in my
Okay.
queue to read. So,
Okay.
but definitely, like when I hear stuff like that, and I hear that somebody has done it, and now they're trying to stop it. The first thing I hear is black and white. That's what I hear. Like I hear
Mm,
somebody that doesn't look like me was
mm,
able to do it, and now somebody who does look like me is coming back like, yo, I'm trying to do the same thing. I don't know if this is true because I
mm,
don't know who's asking for these permits, but that's
right.
what I hear.
Right.
And when you bring up that, and because like I said, it's going to take away from their value. Like if
Right.
the properties are valued because of the roof decks and you don't have one, like we talked about appraisers assessing value, that's going to take away from their value. And I
Right.
think it's intentional, in my opinion.
Mm. Yeah, it could be some insider job, man. Philly Duffy is not new to new
Yeah.
to the insider jobs.
Oh yeah. Oh yeah. I mean, it's definitely, and I don't like to use the word corrupt because you don't know
Mm,
the inner workings of,
right.
I say politics, so people know each other. They that's how deals are made. People make deals on golf courses,
Relationships.
relationships. Like it is what it is. But when it goes from relationships to illegal kickbacks or insider
Mm,
information, that's when I have a problem.
right.
But if you're going to give everybody the same playing field and let everybody do the same thing, like you say, either they got to take their roof decks down, or let me put mine up so I can continue to enjoy the value that they're enjoying.
Right. Or if you're worried about property taxes going up, then you have the Homestead Act
Hmm.
as far as to compete with that. So maybe put some more money in the Homestead Act for individuals who don't have a rooftop deck,
Hmm.
if you know what I mean. That's the case. But just to cut my knees off from doing that, to me, I'm not sure that's the answer. But maybe I don't know all the inner workings because I'm not in city council.
Right.
Uh, any case. Well, listen, man. Why don't you tell the people where they can find you at?
Yes, I mean the easiest way to find me, you guys can go on my website. It's affluent affluent has all my contact information on there, cell phone, email address, everything is on there. Fill out a loan application. If you guys have a question, shoot me a text, man. My phone's usually in my hand. Shoot me a text. Let me know what the question is. If I don't have the answer, um, I'll get it for you. So my number is 856-270-6579. Shoot me a text. Say, hey Lester, I'm just thinking about, can I do X, Y, and Z? And I'll let you know if I can do it, or if I know somebody who can do it, or if I can't do it, or it's not possible, or whatever it is. I'll try to help you out in any way that I can. Because to me, education in this industry is the thing that is the most paramount.
All right, I agree, man. And this is again Khalid Nathan Aleem, the real estate boy. If you're looking to buy a home, sell a home, or invest in real estate, I got you. If you have any um, loan or mortgage needs, please reach out to Les. And for some reason, if you can't find his information, reach out to me, and I'll definitely connect you, man. Until the next time, this is Real Estate Soul, where we look to bring you the real estate information with a little bit of soul, man. Out to the next time.
All right, I talk to y'all.